Imagine you wake up one morning to the headline, war declared, stock markets crash, the rupee is falling on every news ticker, social media is full of rumors. Banks will freeze your money, government will take your deposits, withdraw everything right now. You open your banking app, stare at the number on the screen and think, this money in real war, does this actually stay mine? That's exactly what we are talking about today. What will happen to your money in the bank if a large country goes into war? This video is India focused, but we will use real examples from Ukraine, Russia, Lebanon, and India's own history and then bring it back to you. Will your money still exist? Can you withdraw it? What about UPI cards and ATMs? And is full banking shutdown possible in big country like India? I'm not here to scare you and I'm not definitely here to butter you. I'm here to talk like a friend who understands bit of geopolitics, finance and tech and wants you to be prepared and not paranoid. Let's go step by step. This is not a financial advice. I don't know your personal situation and I'm not telling you to buy or sell anything. This video will do three things. Explain how wars typically hit banking systems, look at real examples from recent years, give you practical principles so you can think better about your own money. Cool. Let's start. When you see 2 lakh or 20 lakh in your bank app, what is that actually? It's not a box in the bank with your name on it. Technically, it's a promise from the bank to you. Your deposit is the bank's liability. The bank has taken that money and lent it out as a loans or invested it. So in normal times, you trust the bank. The bank trusts that not everyone will ask for the money on the same day. And that's how system works. In war or deep crisis, two big fears shows up. Will my bank survive? Even if it survives, will the government or central bank limit what I can withdraw? To answer that, let's see what actually happened to real people in real wars and crises. When Russia invaded Ukraine in February 2022, the Ukrainian government declared martial law. The National Bank of Ukraine moved fast. It fixed the exchange rate for a while, restricted how much foreign currency people and businesses could buy, limited many cross-border transfers to stop money from escaping the country, controlled cash withdrawals and card transactions abroad. Why? Because in war, if everyone tries to convert local currency to dollars and move money out, the currency can collapse overnight. Then imports like fuel, food, weapons become impossible. So Ukraine chose better to protect the system even if people are unhappy that they can not freely move money. So important point here is most people did not lose ownership of their deposits, but their freedom to move money was heavily restricted. On the other side, Russia faced something different. After the invasion, Western countries removed several major Russian banks from SWIFT, the international messaging system used for cross-border payments. What did that mean for ordinary people? Sending money abroad became extremely difficult. Foreign cards stopped working properly inside Russia. The ruble initially crashed. Russia brought in its own capital controls and pushed people towards its domestic payment systems. Again, people inside Russia could still use local banking, but international finance became a mess. So, for your money in a war, maybe your bank is fine, but the outside world's connection to your bank can get cut. Lebanon is not a war example in the classic sense, but it's a brutal case study of what can happen to deposits. Since 2019, Lebanon has gone through one of the worst financial crises in modern history. The currency lost more than 90% of its value. Bank imposed strict withdrawal limits, often only a few $100s a month, and people could not freely access their own savings. Some depositors became so desperate they literally held up banks not to steal but to rob their own money. As of late 2025, the Lebanese government is still working on laws to slowly pay back depositors over many years, and many savings have effectively been destroyed in real value. This is the nightmare scenario. Your money technically exists on paper, but you cannot get it out freely, and its purchasing power collapses. Why I'm telling you this? Because it shows a crucial truth. In big crises, the danger is not always bank closes overnight and money gone. The bigger danger is slow death, limits, delays, and inflation eating your savings. Now let's come home. We are talking about a large country like India with over 140 crore people, a big formal banking system, digital platforms like UPI that whole economy runs on. India's constitution has specific provisions for national emergency like articles 352, 360 that can be declared in case of war, external aggression or armed rebellion. Past emergencies were declared during in 1962 Sino Sino-Indian War and the 1970 Indo-Pak War. Alongside that, we've had like the Defense Act or Defense of India Act 1962 and its rules, which gave the government very broad powers during the war: control over finance, trade, communication, and supplies, power to make rules considered necessary for defense and maintaining essential services. So, in a serious war, the Indian government legally can impose capital controls, limits on sending money abroad, order temporary closing of markets or bank holidays, control foreign exchange more tightly, prioritize which sectors get loans and foreign currency. That does not mean they will automatically freeze everyone's saving, but it means the legal tools already exist to strongly manage the financial system in wartime. As of early 2026, India has deposit insurance through DICGC, Deposit Insurance and Credit Guarantee Corporation, a subsidiary of the RBI. It covers 5 lakh rupee per depositor per bank, including principal and interest. This applies to savings, current, fixed, and recurring deposits in that bank. The government has been considering increasing this limit beyond 5 lakh, but as of now, the formal insured amount remains 5 lakh. Important nuance here is by number of account, this 5 lakh limit fully protects the vast majority of depositors. By total money, it covers only a part because richer individuals and companies keep much larger sums. In plain language, if you have 3 lakh in one bank and that bank completely fails, DICGC is designed to pay you back after some delay maybe. If you have 30 lakhs in one bank and it fails, only 5 lakh is insured. The rest depends on how the resolution works out. That's in normal times of a bank failure. In war, the government and RBI would likely fight hard to keep the banking system functioning because the army, government salaries, and supply chains all depend on it. Now, let's answer the big fear head on. Can India just shut down banks and take everyone's money if war starts? A few possibilities are here. In sudden shock, say a major surprise attack, the government might announce a bank holiday for 1 to 3 days, markets closed, restrictions on large withdrawals while they figure out what's happening. This has happened in other countries in various crises, not only in wars. Short term, very possible. Long term, nationwide closure, highly unlikely because government itself needs the banking system alive. Salaries, pensions, ration systems, logistics, all run through banks now. A full shutdown would turn a military crisis into a civilian economic disaster. Now, what is very realistic in a serious India war scenario? Limits on sending money abroad, tighter rules for buying foreign currency, possible temporary limits on very large cash withdrawals or high value transfers, close monitoring of suspicious flows. Think of something similar to what Ukraine or Russia did, adapted to Indian conditions. The goal would be to stop panic runs on banks, prevent rich individuals from rapidly moving billions overseas, keep foreign exchanges reserves for essentials like oil, medicines, and defense imports. Now, the big nightmare image is government will just take 30% of everyone's deposits. Historically, outright ballings or forced cut to deposits have happened in some crises, for example, Cyprus in 2013, but they are politically explosive and usually applied to a very large or uninsured deposits. In India, such a move on ordinary retail deposit would be politically suicidal, economically damaging. People would never trust bank again, totally against the government's long projects of pushing people into the formal system. Now, much more likely is targeting of a big corporate or ultra-rich capital. Tax changes, war bonds, higher inflation, indirect ways of extracting resources. So could something bad happen to large deposit in a worst case scenario? Sure. But the idea that war equals to all your bank savings instantly stolen is too simplistic. Okay, let's get practical. Even without legal restrictions, war can break three things in three ways. Infrastructure damage, power lines, data center, telecom networks, cyber attacks on banks, payment systems, government networks, deliberate shutdowns, emergency internet cuts or restrictions, which we have talked earlier. Now, let's talk about ATMs. ATMs need power connectivity to banks' core system. In a major conflict, some areas may see ATMs go offline or run out of cash. Banks may limit daily withdrawal amounts. Long queues can become normal. Second, UPI and card payments. UPI has become like oxygen in India, but it depends on your phone plus battery, the merchant's device, mobile network, internet, NPCI, and bank servers working smoothly. In big crises, even temporary internet or power cuts can kill UPI cards payment locally. Merchants may say, "Sir, only cash is acceptable." So the paradox is your money may be safe in the banking systems, but your ability to use it in daily life can be temporarily crippled. That's why we need to talk about what ordinary people can actually do. So let's be clear, you and I are not the finance ministry. We cannot control war, sanctions, or central bank policy. But there are some common sense moves that reduce your vulnerability. Panic is when you see a scary headline and think withdraw everything. The problem, if everyone does that, even a healthy system can break. You will stand in an 8-hour queue, maybe get limited cash, and now you are holding a pile of notes in a risky situation. Instead, accept that some level of risk will always exist. Focus on resilience, not perfection. Now, keep a reasonable amount of cash at home, enough for 2 to 4 weeks of basic expenses, food, medicines, local transport, small emergencies, not your entire life savings. Inflation plus theft risk plus fire risk equals to bad combo. Think of it as a if digital payments and ATM died for 10 to 15 days. Can my family still function? If yes, you are better prepared than 90% of people. Now, avoid keeping very large sums in one single bank, especially small cooperative banks with weak governance, exotic new institutions you do not fully understand. You don't need 15 accounts, but for larger savings, split across 2 to 3 solid banks. Respect the 5 like BIG, CGC, insured limit per bank when deciding how much to live where. Again, this doesn't protect you from every war scenario, but it reduces single point failure risk. During times of tension, you will see super safe 10% guaranteed, war-proof investment. Be careful if you are choosing between a slightly lower FD rate in a stable, well-regulated bank and a much higher rate in a shady institution. In a crisis, return of capital matters more than return on capital. Okay. People often jump to extremes, all in gold, all in crypto, all in dollars abroad. Each of these has its own risk. Gold is storage, theft, liquidity, pricing games. Crypto volatility access during internet outage, regulatory uncertainty, and foreign accounts, legal issue, capital controls, political risk in that country. A more realistic approach for someone with significant savings is to think in layers. First, liquidity layer, cash plus bank balance you need in next few months. Second, safety layer, FDs in strong banks, some government bonds, etc. Third, growth layer, equity, businesses, high risk investments. The exact mix is personal, but the principle is don't bet your entire future on one instrument that can be frozen or smashed in a specific way. Let's bust some common lines you will hear on WhatsApp University. Myth 1. If war happens, government will instantly steal everyone's bank money. Reality is government need trust to run war economies. It's far easier for them to use inflation, taxes and capital controls than to directly loot small depositors. Direct confiscation of normal people's deposit is extremely rare and politically dangerous. Myth 2. If I move all money to cash or gold, I am 100% safe. Reality is cash can be lost, stolen, or devalued by inflation or even by currency reform. Gold is useful, but it's not very helpful if you suddenly need 20,000 for medicines tomorrow and jewelers are shut and buying at huge discount. The goal is not 100% safe, it's balanced risk. Myth 3. Big countries like India can never have serious restrictions, they are too big. Reality. Big countries have more tools to stabilize the system, yes, but they also face bigger shocks and can absolutely impose restrictions under emergency laws, especially related to foreign exchange, large transfers, and markets. So the smart stance is neither blind fear nor blind trust, informed realism. Let's summarize the entire video in plain bullets. In war, the biggest risk to your bank money are not magic delete buttons. They are capital controls, withdrawal limits, currency crashes, and temporary shutdowns of payments. Then real cases shows the pattern. Ukraine martial law, Russia sanction and swift cutoffs, Lebanon financial collapse. Then India has strong tools and also strong powers. Emergency laws historically gave government wide control over finance in war. Deposit insurance currently covers 5 lakh per depositor per bank, and the government is discussing increasing it, but it hasn't yet. Then a full long-term shutdown of all banks in India is extremely unlikely because even the government cannot run a war or a country without functioning financial system. But short-term bank holidays, strict limits and disruption to UPI and ATMs, that's realistic. Ordinary people cannot remove all risk but can reduce it by keeping a modest cash buffer, not concentrating huge money in one weak institution, respecting deposit insurance limits, and avoiding too good to be true schemes, thinking in layers of liquidity and safety. If you remember just these 5 points, you are ahead of most people who haven't thought beyond FD fixed day and so life fixed day. If you are still here, it means you actually care about understanding, not just headlines. Respect for that. In this video, we will talk We talked about what war can do to your money in bank, how governments balance the system survivals versus individual freedom, why your money might exist on paper but be hard to access, and how to structure your finances so you are not completely helpless if things goes wrong. If you haven't watched the previous video on what happens if large countries internet goes down, watch that next because money plus internet are now deeply connected. Now I want you to do two things after this video. Take 10 minutes and honestly ask yourself, if UPI and ATM stop for 2 weeks, what would I do? Is all my money sitting in one place? Share this video with at least one of your friend or family member who keeps saying that यार वॉर वॉर हो भी गया तो क्या होगा. Let them actually see what could happen with facts, not fear. If you found this helpful, hit like, drop a comment telling me what you want covered next, maybe gold versus FDs versus stocks in wartime, and subscribe because we are going to keep breaking down these uncomfortable topics in simple language without the drama and without the buttering. Thanks for watching this one. See you in the next one.